This morning I'm going to talk a little bit about the upcoming tax season and some changes. First I'm going to talk about preparing for tax time. So the first thing to do is to start with your records. Make sure that all your documents are well organized and that you've tracked and accounted for all your income and expense items. One good kind of rule of thumb is to make sure that throughout the year you're keeping your business and personal expenses separate. It's a good idea to have a separate checking account for your business and another one for your personal. It just makes it easier to keep track of things. I think there's less questions during tax time as to whether something was a business or a personal expense. Also, it's a good idea to have a separate credit card or debit card, one for your personal items and one for your business, so you don't have to go through all those credit card statements and try to pick out what was business versus personal. And then once you do that, use only your personal one for personal stuff and your business for business purchases. Also, stay on top of your accounts. So if you do maintain multiple accounts, make sure that transactions are being recorded appropriately in the separate accounts and that you're keeping track of those multiple accounts. Next thing, eliminate unnecessary documents. So we all get tons of mail and have lots of receipts. Kind of general rules for your own records and then for what we need at tax time generally. So bank records and checks. So you need to keep bank records and check stubs if you get them back from your bank, but for anything that's deductible for taxes or business related. Also, if you make any improvements to your home or mortgage payment, those are good to keep. Receipts on all that. If you have receipts that are personal from wherever you shop, groceries or whatever, you don't necessarily need to keep those for a long period of time. If you use your credit card, have the receipt, make sure it's accurate on the credit card, and you can get rid of those receipts. Usually for credit card receipts, keep those if they're business. If they're personal, general rule is make sure that everything matches and that there's nothing strange on your bill, something that you didn't authorize or purchase. And then once everything's matched up, generally, you can get rid of those if they don't have business expenses on them or tax-related items. Pay stubs also. Usually I tell clients that you need the last paycheck stub of the year and of course your W-2. And important thing is once you get your W-2, compare it with your last paycheck stub to make sure everything's in order. The best time to catch things is right when you get that W-2 and not when we're coming around to April 15th and trying to file and find an error then. So make sure you're taking care of that. Make sure you have all your tax documents, including your W-2s and 1099s, in order to prepare for your tax appointment. You should have these documents by the end of January coming up. Also, if your tax preparer sends you worksheets and organizers, complete those to the best of your ability. It's very helpful if we get information that's organized and those worksheets and such are filled out, and we don't have to spend a lot of time going back through other records to try to fill in the blanks. Also, a good rule of thumb is to take that organizer or those worksheets and then look through them. The organizer will show, if you had a W-2 from an employer last year, do you have that this year? If you do, make sure you have that, check off that you do have it. If there's one that you're not expecting, W-2 or 1099 or something, you can cross it out to give the tax preparer an idea, let them know not to call and ask for that you don't have that. Another good tip is to contact your tax preparer during the year if your financial situation changes. So if you're selling land or rental, you have a rental property you're selling machinery and equipment, and you want to know how this is going to affect your taxes. For when you file, you should give your tax preparer a call. Most times for things like that, you may need to make estimated payments, and those need to be made in the quarter that you're selling those assets. So you don't want to come to the end of the year and be doing tax planning with your tax preparer and find out that you sold something in March and should have made an estimate and maybe made two along the way, and that you may end up short at the end of the year. And then schedule a year-end appointment. You can do more in-depth tax planning at this appointment. Hopefully your books and records have been kept in order, so everything's up to date. You can talk about any credits that you might be entitled to, answer the questions that you have now while we have more time than we do in, February, March, and April. And then also talk about things, such as maybe putting money into an IRA, a health savings account if you qualify, and, or 529 plan, or something like that. Some contributions require you to do those by the end of the year, and other ones allow you to do those before the filing deadline. So that's good to check into those before the end of the year. The next topic I'm going to talk about are some changes for this tax season. So for employers, beginning with this, in 2017, this upcoming filing season, the IRS has changed the deadline for when employers have to submit their copies of the W-2s and 1099 forms to the government. Before, they had to be to the recipient, so your employee, you needed to get that to the W-2 to your employee before January 31st. Now you also have to submit the W-2 with the related W-3 transmittal to the Social Security Administration on or before January 31st. Same thing with 1099s that report non-employee compensation in Box 7. You have to have those to the IRS on January 31st. There's no option to wait until before you could do that on February 28th, but there's no option to do that now. And the reason for this, there's been a lot of identity theft, tax fraud. The IRS is trying to make sure that they can start matching W-2s and 1099s before somebody can file, a return on your behalf with a fake W-2 or 1099. So they're trying to do a better job of catching identity theft before and alleviating it before it happens. So because of this shortened deadline, you need to make sure that you have all the information to provide the 1099s and W-2s to the recipients and to the government. Make sure that W-9s have been filled out and you have the complete information, correct names, addresses, and social security numbers. Verify your employees' filing status, confirm their mailing addresses prior to the end of the year, and then double check all your returns for accuracy. And make sure you're getting your stuff to your tax preparer as soon as you can in January if they're doing your W-2s and 1099s, so those can you meet the filing deadlines. Some changes for return due dates. So starting with this tax filing season, the IRS has changed the due dates for C corporations and partnership returns. So if you file a Form 1120, that used to be due on March 15th. Now the filing deadline is April 15th, which will be the 17th this year because I believe the 15th falls on a Saturday. Partnerships that were due in April are now due March 15th. So if you file a Form 1065, and there's no change to S corporations. The reason behind this is partnerships and S corporations require K-1s to be sent out to the owners or shareholders, and so the IRS wants those folks to be able to get their K-1s earlier in the tax season so it doesn't come up against the deadline for them to file their individual returns. On the Wisconsin side, there's been a change to the farmland preservation credit. If you get the farmland preservation credit, Here I've listed the eligibility requirements. The first 5 bullet points are not anything that's changed. You know, you must be a Wisconsin resident. Your land must be meet one of those 3 requirements. Must have produced at least $6,000 in gross farm revenue in the previous year, or $18,000 over 3 years. And then property taxes must have been paid in order to claim this credit. What's new on this is that now the state is requiring that you have a certificate of compliance from the county to show that you meet the soil and water conservation standards. So you all, if you're in this, you should have that now, and that has to be sent with the tax return when it's filed. They will also give you a 7-digit code that we need to enter on the farmland preservation credit screen, and that code, my understanding is that code will follow you. The first year you have to submit the certificate, but after that you can use the code and have to use the code in order to be able to get that farmland preservation credit. Some additional changes, these are on the federal side. So if you are getting a credit for earned income credit, American Opportunity Credit, or the child tax credit, the IRS is going to hold refunds if you're getting any of those types of credits, and not just the refund for that credit, but your entire refund until February 15th of next year. And after that time, they are saying that it would probably take about 21 days from that hold, February 15th hold date, for you to get a refund. There's lots of tax fraud relating to the earned income credit especially. They must see some with the American Opportunity Credit and the child tax credit also. Having to do with dependents is most likely the reason. So they're also going to require, right now when we have somebody with an earned income credit, we have to go through an interview process where we have to ask them a series of questions, and which have to be answered in a certain way in order for them to qualify for that credit. The IRS is including, and that's called due diligence, the due diligence requirement. And the IRS is reformatting that form to include the American Opportunity Credit and the child tax credit. So if you're qualify for either of those, we have to also do that form and go through an interview process to make sure that you in fact do qualify for that. So an additional form to do for those 2 credits anyway, the American Opportunity and the child tax credit. The laws that are currently in place, I'm not going to read through all of these. Not much changed from 15. You know, the standard deduction and the personal exemption amounts go up a little bit every year. We still have the 7 tax brackets, as you see there. Single filers are in the 15% tax bracket as long as they don't go over that $37,650 amount. And married filers filing a joint return can be in the 15% tax bracket up to $75,300. Same thing with capital gains rates. They remain the same if you're in the 10 or 15% bracket. There's no capital gains tax and long-term capital gains and qualified dividends. In the middle tax brackets, in the 15% bracket, and then if you're in the highest tax bracket, the 39.6, you'd pay 20% on capital gains. The federal estate tax exclusion this year is $5.45 million, meaning if you die in 2016, you do not have to pay any kind of estate or death taxes unless you go over $5.45 million in your estate. And the annual exclusion for gifts is $14,000. Depreciation. So the Section 179 expense deduction was made permanent and indexed for inflation at the end of last year. And by made permanent, obviously that is permanent until Congress changes it. However, with what happened on Tuesday, I don't really expect any changes in the near future. The deduction amount is $500,000. The deduction is reduced for purchases over $2,010,000. That number was actually indexed for inflation. The $500,000 one, because of the indexing percentage, didn't make that much of a difference, so they left that at $500,000, but you will see that go up at some point in the next couple of years. And other than that, nothing has really changed with the Section 179 deduction. It applies to new and used assets, like machinery, equipment, single-purpose ag buildings, like bins, drying systems, livestock barns. Bonus depreciation is 50% this year and 50% next year, and then it will phase out over time. It'll go to 40% in 2018 and 30% in 2019. And after that, not sure if it's going to stay at 30% or if it's going to be zero. That will be determined at a later date. Wisconsin now follows federal with the 179 deduction, although Wisconsin still does not allow bonus depreciation. This year, the agricultural credit is 7.5%. It's up, that's the highest percentage. It's up from 5.025 in 2015, and that's, as of right now, where it's slated to stay. That credit, if you can't take it in the year it's calculated, you can carry it forward for up to 15 years. So if you don't have income to offset because you didn't have a good year, then we can, or you had other credits that you took, we can use that in future years. Only applies to farm income, and it actually is added to your income in the year after you compute that. So if you have a ag credit that we compute for this year, we include it in your income next year. The subtraction modification, so that was the Wisconsin subtraction that started in 2014, so we're in the third year of that modification, and that was to get Wisconsin basis in line with federal basis because of differences in 179. This will go on until 18, and then your basis should be in line state and federal. However, if you take bonus on the federal side and not the state doesn't allow it, it still may not be in line, but the idea for the 179 will be that your assets will be in line there. And then any assets that you sold after January 1st of 14 have the same gain or loss on the federal return as they do the state return because of this subtraction modification. So what's happening next year? There's just a few things here. Not everything is out yet, but personal exemption and standard deductions are going up just a little bit. The federal estate tax exclusion amount is going up to $5.49 million, but there is going to be no change to the annual exclusion amount. That's been $14,000 now for a couple years, and that's going to stay that way as far as I know right now for 2017. Just a few more, the contributions for retirement, 401k, 403b, and most 457 plans is $18,000, which is unchanged from this year. Catch-up contribution is still $6,000, and then the IRA limits also remain unchanged for next year.